here. So we are in our kind of last stretch here of the internship. And we just went through personal kind of cash flow, tax analysis. We're going to spend this week going over business cash flow based on the business tax analysis. And then we'll land the plane next week on income property analysis. So how do you analyze properties, apartment complexes, retail centers, office buildings, et cetera, et cetera. So we'll go through that next week. And thankfully, that's probably the easiest of the bunch. So I think you guys will like the fact I saved the easier part for the last, and the hardest is generally in the beginning. So with that in mind, let's dive in to business tax analysis. And before I start, I want to just maybe ask both of you, what is your understanding of business tax analysis to the best degree you can? Give me sort of your feedback on that. So why don't we start with Tate?
Yeah, I'd say somewhat similar to personal, where you kind of look at, balance sheet, income, liabilities, and again, just looking at the flow of money. So instead of personal, this time business, seeing, what businesses, what their main expenses are going to be, how their money's flowing, what their bottom line is going to be, just looking at all things, essentially when the business is functioning and running at, in a kind of homeostatic environment, what does the money situation look like? So yeah, everything entailed with that.
Yeah, that's good. Yeah. It's looking at the balance sheet, looking at the income statement, trying to identify, where's the money flowing. And so that's good. Good job. What about you, Suha? What's your understanding of the business?
Tate pretty much said everything, but it is he's literally covered everything. But it's basically focusing on the business cash flow. Like he said, it's where the money's coming from, their debt. There's also more amortization, depreciation. And just, I know there was a lot of their debt payments, and there was a lot of sections on their payments, what they owe, interest and property taxes, stuff like that.
Yeah. Suha, for a second, you sounded like my son after I asked my daughter a question, and then he goes, yeah, whatever Kate said, that's the answer. So no, Levi, you have to answer your own.
Yeah, let me just add more little twist here and
exactly. There. I'll twist a little something. No, but you're right. There's some different categories that we're going to go through. And so I want you guys to think about, again, I always try to boil things down just so you can have kind of a main thematic, thing. So always remember a couple things. We are trying to identify how somebody has been managing their business. Okay. So just think about that for a minute. What we're doing is we're trying to understand, how have you been managing your business? Now, I could go in and sit down with somebody today, and I could sit across the table from the automotive company or the law firm or whoever it is, and I could ask them questions. How do you run your operations? How do you run your management team? How do you hire? All these things. And they can give me all these answers, and they could give me probably pretty good answers, at the end of the day. But when the rubber meets the road, okay, the financials really tell me the true story of what I would deem to consider the aftermath of a bunch of either really, really good decisions or a bunch of really, really bad decisions. Okay. So if you look at the financials, they are a cumulative effect of the aftermath of management making either really, really good decisions or really, really bad ones, or maybe somewhere in between, right? But either way, that's what you're looking at. And it's kind of hindsight, right? I mean, it's a little bit in the rears. So just think about that is what we are doing almost the same thing. I talked to you guys and said, well, if I want to really know what matters to you and how well you're doing, I'm going to look at your bank statements. Okay. And it's going to tell me what's really important to you and how you manage your money, you know? And so then that might be a little scary for some of us, like, ooh, no, I don't want you to see that, right? But that's what we're doing here, okay? And from a credit perspective, okay, from the bank's perspective or the financial institution's perspective, they're trying to just ask themselves the question, should I lend you money? Can you pay me back based upon those things? Okay. That's what we're trying to understand when all is said and done. So you have a couple different scenarios that I think is important when you're looking at a business. All right. The first one might be, it's a startup. Okay. You might look at something and go, well, this is a startup company. And it's either somebody that was passionate about something that they have no experience to do, or it might be somebody that is very astute, or maybe they have a skill, you know, that they've had for years and now they're just going to go out on their own, right? And so in that particular scenario, I'm not going to have anything historically to look at, but we're going to be banking on the fact that they're going to have given us projections about what they believe is going to take place in the future. Okay. So if you're looking at that, what do you think is important to understand if you're looking at a startup operation when it comes to looking at some of their projections? Any ideas?
Would it be like their personal, like how they can manage their money? Like, for instance, if I'm opening, like you said, a coffee shop, right? And I needed to go to a bank to lend money. So would it be focused on my personal analysis, if like I can even manage my own personal, like my personal money wisely first?
Great. It's a great area to focus on for sure, Suha, because what you're saying is, hey, I'd like to see how you're managing your own money, right? Because history tends to repeat itself, right? If you're a crappy money manager of your personal, what makes you think you're going to be good in business, right? It's kind of like one company, a big association I'm a part of one time, and I remember we were talking about kind of a moral topic, and he said, well, I just leave my morals at home. And I said, so you're saying you throw all of your morality out when you walk into the office? And everybody got really quiet, and he goes, that sounded pretty stupid. And I said, well, you said it. I didn't say it, but you know, so yeah, I mean, you know, it all translates when all is said and done. So to your point, you're going to look at maybe their personal financial statement, say, gosh, do you have some cash? You know, that certainly would be important to say. Do you have some reserves sitting aside that if something doesn't go well? You're going to look at their personal taxes, right? To say, okay, do you have some outside income? Or you're just 100% banking on this thing to work, right? You know, or does your spouse work? You know, they got a job and they're making 100,000 a year, and you know, if this doesn't work out, hey, you know, you got something to fall back on, right? So those kinds of things are absolutely important. And then you would also maybe say, let's look at your credit, right? I mean, if you're, you know, defaulting on your credit cards all the time, it's like, oh, you know, maybe we got a problem. So really good. Tate, what about you? What would you want to focus on if you're looking at a startup?
Yeah, I'd say just generally since it's a startup and they're not necessarily going to have a bunch of past information, I'd look primarily at, you know, everything from start date to now, you know, what, you know, I'd be curious what their first step was, you know, when they started the company versus, you know, what their kind of their step-by-step process. That allows me to kind of see a bit into, you know, how their mind's working, where, you know, their emphasis is being placed on certain decisions. And then with that, I just evaluate each step. I'd look at their projections, but I wouldn't mind them too much as to, you know, the actions they've already taken. Depending on whatever the industry may be, I'd look at, you know, where they've invested their capital right now in terms of, you know, are they having, you know, 100 units of excess stock for like a luxury item, or you know, whatever it may be. I would kind of see what they're doing with the money they have as well, and just kind of look at, you know, their purchases, any purchase orders they have, whatever kind of communication they've had with any other companies as far as buying like consultants, whatever it may be. Just looking into that.
Yeah, that's good. Yeah, so you'd look a lot at what their activities are that they're doing today to get to a certain level, right? And so I want you guys to think about, in a startup scenario, this idea that if I give you a projection, the very first thing and the sole thing that I'm going to focus on is, I want you to just think about this, and it's probably good, and you could translate this into a lot of different areas, okay, what I'm about to teach you, which is, one way you can say is, well, prove it, okay, or how did you come to that conclusion? Another way they use is a fancy term, which is, what were your assumptions? Okay, so if I all of a sudden said, I'm going to make, you know, $500,000 this year, then you're going to say, okay, how did you come to that conclusion, right? What process did you go through to determine how you were going to get to $500,000 a year, right? And what you're looking more for is the thought process behind that assumption that they just gave you, right? I'm going to do X. What you're saying to me is prove it. Like, how is that going to take place? Are you going to, you know, it's X amount of relationships you have, and out of those, you know, 50 relationships, you know, I believe my ratios are generally about 25% close ratio. And I know that I'm going to have this much time to do X, and here's the average fee I'm going to make on each one, you know, right? So you're trying to see, gosh, did they think through how they were going to get to that? You know, if you have a coffee shop, okay, well, I know I've studied 3 other coffee shops, and it looks to me like most of them, when they start up, they're usually getting to about 450,000 within the first 9 months. And the reason why is they're each on this kind of corner, and, you know, they're selling this much coffee a day, right? You're looking for some substantive way to justify what it is they just told you they were going to do that, right? Not that there's guarantees, there isn't, but it helps you from an underwriting perspective say, gosh, they really thought through that in some pretty good length. They're backing it up with some data, right? So what do you guys think about that when you hear this notion of kind of prove it, or, you know, what is your assumption? How'd you come to that conclusion, you know?
I agree with that. Sorry, Tay.
Go on.
Oh, good.
I was saying, Dave, I agree with it, because I think you can really, if someone gives you like their like list of their actions and stuff, you can really think like, oh, like, you know, you understand where their head is at kind of, and it helps clear this up. And I think from some, and if they're not towards the right track, you can kind of advise them to focus on some certainties that you might be like, oh, maybe this doesn't make sense to me. So maybe like, what is this? So that can help them go back, focus on it more, and maybe like improve on that, which can help like increase their sales.
Yeah, 100%. You know, great thoughts. But you, Tate?
Yeah, I somewhat see it as kind of the way, when I think about it, I see it as like a math equation, and I thought of PEMDAS for whatever reason, where, you know, parentheses, exponents, multiplication, you know, kind of the whole thing. Like if you have like a very simple PEMDAS equation and say that's your business plan, my thought is you want, you know, the person that you're selling this to or trying to, you know, get on board, you want them to arrive at the same conclusion that you did. So it's essentially trying to walk them through what your step-by-step thought process was, you know, if you follow the steps of PEMDAS, if both people do it, then you're going to arrive at the same conclusion, which, you know, that whatever X may equal. So I kind of see it as like, you know, essentially trying to get both minds to think in the same way, that, you know, get you both to arrive at the same conclusion, like, you know, yes, these numbers make sense. This is well thought out. Kind of like that.
Yeah, I like it. I like the way you put that, because there is a mathematical component to it. You know, I always tell my guys, I'm like, look, I've been doing it for 20 years. And I'm going to tell you, there's just math behind it. If you make X amount of calls and you do it for this period of time and you're consistent with it, the math will eventually just work out. It always has, it always will, but you have to do it, right? That's the key. If you don't do it, it doesn't happen, right? The whole cause and effect thing. Why that works, I have no idea, but it just tends to drop that way every single time. And so you can just have a model to follow through. Henceforth, if I'm able to look at surrounding like kind businesses, and I can come in and justify what they've done and use a conservative assumption based on what they've done, that's a pretty good argument. You know, it's like, hey, I think I'm going to pick up X amount of market share. Here's how we're unique relative to them. And I think we'll probably get X amount of dollars, right? Like, that's a pretty good case to make. Then you just start doing the same thing with expenses. You know, we're going to hire X amount of people. It's going to cost that. That's a little bit easier, right? This is how much it's going to cost. I have to pay rent. You know, these are my operating expenses to run. And what you're looking at, this is why they say most small businesses will fail within the first, year, is predominantly because they haven't actually gone through the exercise of writing a business plan. Okay. It's not that the business plan makes you successful. Okay. It really isn't. It's not like this piece of paper is like poof, you just print it off and there you go. It's that you went through the grueling, arduous process to try to convince not only them, but yourself. Why does this make sense? Okay. We're about to raise $100 million on a fund, and I've had to spend 6 months walking through for myself. Why is it that I think this makes sense to have people put $100 million in here to do this, this fund, right? Like, I needed to be convinced myself. Why does this make sense? How are we different? What are we going to do? How's this all going to work, right? So a lot of work goes into just finally saying, okay, we're ready to go. But it's the process you go through to do that. And that's what you're looking for from an underwriting perspective. Is someone just like flipping stuff out of the air? That's going to make you a little nervous because you're like, well, gosh, you didn't even think about this, So I'm just kind of giving you, again, I always try to start philosophically about when you're looking at something, because sometimes we just go math, it is math and it's good, but you're looking for behavior behind the numbers, okay? Because it's the behaviors that ultimately lead to the numbers, right? I mean, Tate, you know this, right? Like, somebody could say to you, well, I'm the best power lifter in the world. And you're like, well, prove it. Like, go to the gym. Let's see how much you can lift. And I want to see that you actually show up at 5:30 in the morning and you're working your butt off, right? And you've done that over and over and over again. And that's what you're looking for. Like, talk is cheap. Okay. So that's what you're looking for here. So does that make sense to you guys? Does that, what I'm saying, kind of resonate? Okay. So I always try to give you sort of just more of a practical thing, because it really is practical at the end of the day. This isn't rocket science that we're doing here. A lot of this stuff ends up being very practical, and you use a lot of intuition, and you're trying to figure out who's this person, because, sometimes I have such great clients and they're so smart at their craft, because we really only work with the best people. Sometimes I literally just show up with them and I shut up. Like, I just walk in with the lender and I just say, you talk. Like, I don't even say anything. You're just so good at it. Like, why would I try to, add anything? I can't. Okay, so when we're looking at tax returns, okay, when you're looking at a corporate or a company tax return, this is what's called an 1120S. So this is a sort of an income tax return as a subchapter S corporation. They have what's called a limited liability company. That started, I can't even remember, probably 20 years ago. They started these new corporations called the Limited Liability Corporation. Became the raving success because it was less complicated to file them and run them than a true C corporation. Okay, C corporation is designed to file its own tax return, and then the money stays in there. So you pay tax on the tax return, then you pay tax on the personal taxes. So you get double taxed essentially. With a limited liability corporation or a partnership, the money passes through to the personal tax return. Okay. And so they don't get double taxed. So the people love that. And they still get the benefit of the limited liability elements. So do you guys know what it means when it's a limited liability corporation? Do you even know what that means? Like,
Isn't
why?
it just essentially that like a sole proprietor, you're going to have essentially full exposure to liability, and then partnership, it's going to be shared liability, and then limited liability. Just generally ways to lessen your personal liability.
Exactly. So what happens in a limited liability corporation is when you set it up, you fund into it the assets that are in that corporation, and it's limited to whatever's in that, right? So someone can't come after you personally. They can only go after what's in the business. And so that's why people like it, because if you were just a sole proprietor, they could actually come after you personally, and your personal house, your personal assets, all those things. And so this protects you from that. So just a little side note to understand why people do LLCs. You'll hear that a lot in this industry. So this is filed. It's a tax turnover in S corp. It's S corps are just another way for the way that they file allows people not to get double taxed on some things. So, so you start up here and you've got gross receipts for sales. Okay, pretty straightforward. It's just whatever they made gross that came in the door. Okay. And then look what it says here. So what's cost of goods sold? Anybody take a crack at that?
Just the total cost of whatever product you're selling. So, yeah, I guess.
Yeah, pretty straightforward, right? Like whatever widget you're selling, what did it cost to make and sell that widget? And then that would go in there because you're trying to get what they consider kind of a net profit margin. Meaning, like, what did you make on the actual product profit margin itself? And that would be this number down here. Sort of I guess it would be gross profit, right? Like what do you actually net make in this gross profit? Okay, that's why they kind of use the profit up there, because you didn't really make a net profit, but you did make one based on the commodity. Okay. So here's my question to you guys. If somebody sells $3.2 million in sales, does that mean, well, let me put it this way. Could somebody sell $3 million in sales and it shows that they made a profit, but they actually end up going out of business? Is that possible? So they show here that they made 3.2 million. They show that they made a profit, and they could potentially go out of business. Even though you show they're making a profit.
Is this referencing like this specific kind of thing? that we're
Well,
looking
it's,
at
let,
here?
let me try to frame it a little bit differently. When let's just say you and Suha go out and, let's say that Suha's the buyer, okay, of your widget, and you're the seller of your widget, okay? And so you go to Suha and you say, Suha, I've got this awesome fancy gum that nobody's ever seen before, and it actually makes you turn different colors like purple and blue and all this fun stuff. And so I was like, that's really cool. That'd be awesome. So she says, well, I'm gonna buy 50 cases of that from you, okay? Because I think I could sell these to a bunch of people. So she says, write me up an order, right? So you go ahead and sell her $500,000 worth of this gum that makes you turn different colors, okay? So you sell that to her for $500,000, all right? Now, you go back, there's two ways that manifests itself. Either Suha literally buys that from you and cuts you a check that day when the thing comes in, or what's the other scenario?
On delivery?
Yeah, that could be on delivery.
Okay.
What's the other scenario? That there is a receivable, meaning that what happens is Suha says, well, I'll tell you what, can we put it on credit? You know, I'll pay you in 120 days. Okay. So, so I'm going to buy that from you, but I'm going to pay you, Tate, in 120 days. And Tate's a salesman, so he's like, hey, that's fine with me. I got to make my sales. You know, I'll take it on credit. That's fine. And so you see, in one scenario, you actually physically got the cash that came in the door. On the other scenario, you didn't get any cash. You made a sale, but that doesn't mean that you actually got the money. Okay. Because Suha, you know, could actually wake up in 120 days and go, hey man, you know what? I'm sorry, like I don't have money and I can't pay you. So can you give me another like 60 days, right? And that could kind of drag out. Now it's technically a default and you get in all this different stuff. Happens all the time, okay? Like Home Depot, when they buy stuff and you go into Home Depot, I mean, they're like the master of just dragging it out and buying products and throwing them on their shelf, right? Walmart does the same thing. And the reason why they can't, it's kind of like, you want to sell stuff on my thing, you do it under our terms, okay? So you can actually sell something and actually not get any cash, okay? Now, what people do in order to stay with positive cash flow, like they can still get money, is they'll actually take that receivable from Suha and they'll go to the bank or some other company and they'll say, hey, you take this and you give me 80% of that face value because I need cash. I got to run my business. I got to pay my employees. And so they'll pay you, you know, they'll give you the cash, 80% of it. You know, it's called receivable factoring financing. And then what'll happen is they'll charge you a really expensive interest rate on it, like 15% or 20% or whatever. And you're willing to pay it because you're like, I need cash. Now I can't wait. Because nobody else is going to do that because it's risky. Because again, if Suha defaults, they just got that paper, you have no way to pay them back. So now you got debt. Okay. So does that make sense? I'm telling you.
I have one question, Dave. What is that? Like you said, we take something to the bank. What is it that we're going to take to the bank?
Yeah. So if you come to me, so Tate just literally went to you and sold you these widgets. Okay. The gum. And you said, you just bought it, but technically, it is a receivable So it's an account receivable, Tate's. Okay, so Tate has an accounts receivable. If you ever look at a balance sheet, what are you gonna see on the current assets and current liabilities? Accounts, right, receivable. Okay, so that would show up on his balance sheet. Means that he has a note, so to speak, that he lent you money in a sense, right? And so you owe him an accounts payable. So on your balance sheet, down at the bottom under current liabilities, it says accounts payable, 500,000 to Tate Inc., right? So Tate can take that account receivable note or that IOU document and go to the bank and say, you take this as collateral. Which means if Tate defaults, they can actually step in and they now have the rights to pursue you, Suha, to collect their money. You guys
That
track-
makes so
you
much
guys
sense.
track- does you guys tracking with me on that?
Yes. I didn't know they have like this type of thing that you just said with the accounts receivable document.
It happens all the time. And so it's just important for you to understand that concept because it happens all the time. You're gonna go, well, how come they don't have any cash? They're sold all this money, but they don't have any cash. Well, all you have to do is look at their accounts receivable and that'll tell you. They sell things, but they don't get them in cash. Now, typically you have 30, 60, 90 days. That's generally the window where people will say, we're going to give you credit for everything 30 and 60, but if it starts to go to 90, we don't really give too much credit to that because that means you're starting to get in a default range. If people aren't paying after 90 days, it's kind of like, well, this is iffy. Okay, so you'll hear that. So anyways, I'm trying to kind of just give you some perspective on when you're looking at this stuff of understanding how people get to where they go. Okay. So cost of goods sold, pretty straightforward. And then you get down to compensation of officers. Okay, and then you have salaries and wages. So what is the difference of compensation of the officers versus salaries and wages? What's the difference?
So specifically for an S corp, does an S corp kind of work as a C corp where they have like a board of directors as
Good.
well?
It's possible. It's not mandatory, but it is possible. And remember, when you think of an officer, it's really anybody that is either at a board level or they have some ownership in the company. Okay. So they'd be considered an officer. So, someone could actually be a CEO of the company, what they would call C-suite or executive level. They might be a chief operating officer and they have the little, small stock in the company. So that's where that compensation would go. Okay. And the reason, why do you think they would delineate the two? Any ideas? Why would they not just lump everything into compensation or salaries and wages? Like why would they have a delineation? Any ideas?
I think just in general, it's nice to be able to see kind of the difference between that, as you said, the C-suite level, and all other, if you have a COO, CFO, and your CEO, if they're combined making 3 million and, salaries and wages totals to 300,000, then there's a pretty big kind of disparity between them, and that might raise a couple red flags, in my opinion.
Yeah. So one of the reasons could be that, it's good to know and say, okay, well, where's the disparity? Where's the discrepancy for sure? What else? What do you think, Suha? Any ideas why they would delineate the two? You could be like, you could be my son and just say, well, whatever he said,
No, I'm not going to use that one again. I didn't think of anything, so I'll just be honest.
It's giving me a hard time. So here's the reason generally why. Okay, obviously from an accounting perspective, it's important to delineate the two. They want to sort of see what's going on. Now, if you sold the company, okay, and you're an owner in the company, it's important for them to understand the delineation, because generally speaking, the officers are not coming with the company. Does that make sense? They're replacing those with new officers. And so what they're trying to figure out is what was the compensation, and is that going to make the cash flow different when we come in? You know, were they paying themselves either too low or too high? Okay. And so it helps from a valuation perspective to understand the delineation from the two. So it's just a way to kind of understand those things when you're trying to value the company, to say, well, we need to take those officers' salaries out there. If someone's paying them, like I told you guys the other day, one of the companies that filed bankruptcy, the guy had a lifestyle of $7 million, you know. So it's like, you know, it's a little excessive by quite a bit. But, you know, at the end of the day, that kind of stuff helps us really get cash flow, because you're like, well, you know, we don't really need to underwrite at that kind of level. Okay. So just something to be cognizant of. Plus, if you're looking at someone's personal tax returns, you want to tie the two together a little bit. So if they're saying, hey, I'm making $150,000, and then you go look at their personal tax returns and it shows $150,000 on here, and then you look at their tax returns, you're like, well, gosh, it's only showing like 50. So there's sort of some matching you're trying to figure out too, is go, well, why the discrepancy? Like here it's showing here, and why is it not showing on here? Right? There might not be anything wrong. You just need to find out like what happened, and so you can understand the story. Okay. So that's just some things to understand about compensation. And the other thing that's just more of a general thing to be aware of is when you're underwriting, it's important to look at all these categories in relation to the other years. So you want to say, well, gosh, this was for the year 2020, but I want to know, what does it look like their revenues 2019 and then 2018, and then the same thing, expenses, you know, all the way down the line. And you're looking for large discrepancies. Okay. So for example, if all of a sudden I look at it and go, well, gosh, you know, it shows that you had salaries and wages of, you know, 100,000 in 2019. And now you have salaries and wages of 282,000 in 2020. Like, what happened? You know, and what are you doing? You know, and if it's a good manager, they're like, hey, we're intentionally ramping up our sales staff because we're preparing for growth. And so we added a lot of new wages. You know, we added some salespeople. So you're like, oh, okay, good. You know, that just helps me understand the story. So again, you're looking at those things so that you can have questions to ask. Like, what happened between these two categories? What's happening here? Okay. So does that make sense? What I mean by like comparing year by year? Good. So what is repairs and maintenance, Tate? What do we mean by repairs and maintenance?
I think it varies industry to industry, but I mean, if you have like a construction company, you're going to need to repair your equipment. Your trucks will need maintenance, repairs, drills, saws, stuff like that.
100%. You got an automotive shop, lots of repairs and maintenance, right? If you're an attorney, it's probably not the big category, right? Maybe you got a copier or a printer. I mean, there's just not a lot there. So it does depend on the industry for sure. What about bad debts? What's the bad debts about, Suha?
Bad debts, I think they're the uncollectible money, like what you said about accounts receivable. They're very similar to that, like where you haven't received the money yet.
Yeah, there's hasn't happened often, but you know, once in a blue moon, we've had somebody that we got to the end of the loan, and I've had it happen a couple of times where, you know, we got to the end of the loan, the guy's like, well, I don't actually have the money to pay you. And I'm like, well, that would have been nice to know. It's thanks for waiting till the loan closes to let me know, right? So so you know, I had to collect payment, you know. Funny enough, or it wasn't funny at the time, it is now, but the very first loan I did in this business was with an attorney who was buying a building for like $1.5 million underneath the market. Okay, he was stealing this property. It was a fantastic buy. And he knew I was a rookie, so he negotiated my fee to like half, right? And then as soon as we get to close, you know, he kept kind of pushing off signing our fee agreement. And we got to the very close, and he said, hey, I want you to cut your fee more. And I said, no, I'm not going to do it. You know, like, you already negotiated more and I'm not going to do it. He said, that's fine. So he closes. And because he never signed my fee agreement, he actually took me out of escrow. And so I didn't get paid. I remember calling him up, and he said, well, keep your shirt on. He goes, I'll pay you whenever I feel like it, you know. So I had to take him to collections, and commercial collections is a little bit more aggressive. So they actually sent someone out to his neighbors, and they could knock on his door and say, do you know your neighbor's not paying their bills? You know, it's kind of silly how they do things. But so I mean, eventually I got paid, but there's a lot of bad debt, you know, that I had to write off on the taxes, you know. So every so often somebody's a little bit of a shenanigans, and they don't want to pay you. So that's what bad debt is. It'll just show as an expense because, you know, you can get paid. All right. So what about rents? What's rent all about? This is an important one. So just, what are your thoughts? When you hear rents, what are we talking about?
Like the money, it's like for example, if I own a building and I have, or if I own an apartment complex and I have people living there, their money that's coming with them as rent, like I'm leasing it to them. It's not their own.
Yeah, it's you know, and so think about it this way, to your point. For a business owner, I have two options, right? I can buy a building, and now I own it, and then I can operate my business, or I can rent the building. Okay, so I can go down the street to the industrial building, and I can sign a lease and say, rent me space, and then I'm paying a check every month for that rent, okay? And so that rent expense is gonna go on there because that's what I pay every month in order to be in that building, okay? Now, my question to you, Tate, is there a potential other rent expense that could be on there besides the rent I'm paying to be in the building?
Yeah, you could have rental equipment, rental land. You could lease pretty much anything, I think.
Yep, you could have lots of things you're renting. Renting equipment is a big one, right? And so that could be a line item that it gets lumped together. So it's really important, and I'll tell you why, and this becomes part of cash flow. When you're looking at rent, okay, if you're buying a building, so if someone comes to you and says, hey, I'm buying a building, when I look at that rent expense item, what do you think a question in my mind is going to be if you're buying a building? So you've been paying rent, okay? Now you're buying a building. So what am I thinking about that rent expense item?
Is
Well,
it consistent?
Go ahead.
Go for it.
I'm sorry, sorry, Tate. Is it like how much you're getting? Is it consistent? Like what has changed? Like,
Not necessarily, but I want you to keep thinking, like, what is it? Okay, so just think about this. I've been paying rent for a while. Now I'm buying a building. So what is it you want to know? What are you thinking about that rent expense item?
I'd just be thinking, like, if you're buying a building, number one, is it like the building that you were renting from? I'd be curious if, you know, it's like a secondary building.
Yes,
If you're gonna
yes.
keep paying rent at another building, then buy another.
Yes, yes. So think that's what you're thinking. You're going to, okay, you've been paying rent expense and you've been in a building, but the question you're asking now is a few things. Are you buying the building you've been in? It's a legitimate question, right? And then what's going to happen to that rent expense? Does it go away?
If you buy the building, yes, kind of, but it gets
Yeah.
transferred to like
Yeah,
you're paying the
it
mortgage.
does. Yeah, it does. But that exactly. So you're replacing that rent, right? Like it's going away. Okay, that is a potential scenario. The other scenario could be you're not getting rid of the rent expense, but you're expanding. So you're buying a building, you're still doing this one, and then you're doing. So that rent expense is not going to go away. Okay, but it stays. That is another potential, right? Okay, so those are the potential scenarios. And the other thing you want to find out too is, hey, on that rent expense, is all of that rent that's a place that you're leasing, or is there like rent? Is there, you know, other equipment that you're leasing? I want to know how much, right? So there's lots of things you need to flush out about that thing to say, is this all just you're paying a lease payment? Are there two buildings you're leasing right now? Like you need to know what is that amount, okay? Because that could really, so if you think about add backs, okay, what you're going to add back into your cash flow, rent expense potentially could be one of those things. Okay, if they say, hey, that rent expense I'm paying of $108,000, that's going away. I'm like, great. And then you're going to recalculate, well, what's your mortgage payment going to be in the future? Okay. And let's say it's like $80,000. Well, that's a pretty good deal, right? Been paying 108, you get to now own a building and you're paying 80. Not a bad deal, right? So something to think about as you're going through the process to try to delineate and understand cash flow. Okay, remember that's what we're doing, trying to figure out cash flow. So you're gonna have to add that back in, means you got to press into the question. Okay, does that make sense? You guys tracking with me on that? Okay, all right. Taxes and license. So what's this all about? What kind of taxes are we talking about?
Isn't that like, oh, your taxes would be like your property tax, if there's any federal, state tax, and then I think licenses are just any business license they had to obtain.
Yeah, it's any it's like taxes in your industry, licenses you have to pay for, sales tax, it's property tax. That'll be another one. Okay. But it's probably not going to be federal or state. Because remember, that's going to go on which tax return? The personal. Okay. So there's all those federal and state. Now, if it was a C corporation, we'd probably deal with another issue, but S corp passes through. Okay, but you are dealing with, again, property tax, sales tax, and licenses that they have to pay, maybe to the state. We have a license to the Arizona Department of Financial Institutions. We have to pay a fee to keep that license. Okay, so that would go as a line item. Okay, so not a whole lot there, but again, you need to know. By the way, if I back up a second, when you're calculating the new payment, it's important that you also take into consideration, it's not just the principal and interest. It's also going to be the taxes and insurance. Okay. So you're gonna have to figure out what the property taxes are for the new building and the insurance that they're gonna have to pay, okay? So, because that's an expense, you know, you weren't paying that before, but you are gonna pay taxes as well, so you need to know what that number is, okay? Interest. What's interest, Suha? You're muted.
I'm so sorry. I was talking to myself.
It's okay.
Interest isn't that just the all like the interest that's building up on debt?
Yep.
It's just, yeah.
Percent. Yeah, again, they could borrow, so this is gonna tell you a story.
Yeah.
Tons of interest expense, right? Then you're gonna go to their balance sheet, kind of understand like, what do you owe? And we're trying to figure out like, what is this interest expense? Is it on the mortgage? Is it on equipment? Do you have a bunch of credit cards? I remember doing a deal with a guy one time, he had like 16 credit cards or something, like he just tons of debt. I mean, it was like literally, it was like a jigsaw puzzle of figuring out like, what are all these loans, right? And so again, there was a story that was being painted of just somebody that was just borrowing money like crazy, you know, and so we had to do like a consolidation. So you're just trying to figure out interest expense, okay, because you're going to add that back in. Okay, so remember, you could add back rent in. You're definitely adding interest expense in. Do you guys know why I'm going to add interest expense back in? To get to what? What's that fun little acronym that I always say? EBITDA, right? Remember, let's go through it again. Earnings before
Interest.
taxes, depreciation, and amortization. And you'll hear EBITDAR. So that's rent. Okay. So you'll hear EBITDAR a lot because they're like, we need to add rent back in. Okay. So just realize that we're always going to add back interest. Okay. The reason why is because you're going to take the actual payment out. So if they owe $100,000 and Tate has to make these payments every month of, I don't know, call it $5,000. Okay. And the $5,000, the interest expense on the $5,000 is $1,000 a month. Okay. The rest of it goes to principal. So at the end of the day, from an accounting perspective, they only let you write off the interest. Does that make sense? I mean, you couldn't write off principal because it's like paying back what you owe. So you're not, but you get to write the interest off. So you're adding it back in because you're going to take out the payment. Okay. When you're running cash flow. Okay. Because when you get to EBITDA, the whole concept of EBITDA is all the money that's available to pay for debt. That's what that really is all about. What is all the money that's available to make debt payments? You guys tracking with me on that? So whatever you hear EBITDA, just understand, associate it with, well, the whole reason they're doing this is to determine how much can the company borrow, right? And still be solvent and cash flow positive, okay? And so they're trying to figure out, they have to figure out, what do you already owe and what payments do you make? And then when everything's done there, do you now have excess cash to cash flow to pay for more debt? Okay, or not. And so that's what that calculation is all about. Okay, so we're about out of time. I'm going to stop there today. Okay, just for the sake of time, and also so that you guys don't